So to everyone who is joining this session afterward, greetings to all of you. I thought it to be imperative to to do this with the class. Again, the fact that it's only few students that are joining is testament to why I'm worried. Please, if you are listening to this recording, just make sure that you don't gamble with this module. Um, Make sure that you don't take any chance comes exam time, because I can see when you are writing. I can see those who have been practicing and who are putting in the effort, and I can see those who are not really putting much of the effort. They are doing just the bare minimum, and that's not right. That's not right. So, again, we are just talking. It's good to talk together and to tell each other the truth, because I feel that if you're not pulling your sleeves for the three remaining modules, I'm afraid that you're going to do very, very bad um, in the exam. So I hope that that's clear, and you change your technique or your mode of studies. Some of you were offline. You have to come online. You have to come back online and put in the effort. All right, so we're going to start this evening. I have Marty with me here, and I'm waiting for Blessing to join. But for all of you, just follow along. But I've made it simple. For example, for question one, I did not want to write a lot because it might again overwhelm you and complicate the question more than it should, because it's a fairly simple question. It's a very simple question, and that's why the solution that I'm offering is very simple as well. And you can see on the screen there, you can see question one, question two, the solution, and also you can see here question three answered. So within a table. And that's basically what I will be doing. And maybe I would like to initiate you to this kind of reasoning so that you can see everything, you know, you can picture everything together, right? So remember that your first question, the following transactions were entered into by MT Ltd during January 2024, right? The date is not very important to us. As to they're telling us that goods were purchased on credit. Now, you know that's trade payable, right? One of the questions that they ask you, always every time you're reading the question, right? Every time you're reading the question, the what is given to you, right? The little story. Check also the questions. What exactly are they asking you? Um, and the question they're asking you is fairly simple. You know the total working capital. They want you to find the total working capital, right? And you know what the working capital is. It's basically your current asset. What are your current asset? Even if you're sleeping, you can remember your current asset. You know that there is inventory, there is cash, there is trade receivable, right? Or our datas, that part of your current asset, right? So you know that by heart. And these are provided to you. But look at sub question two. It says calculate the current liability. And you know what the current liability is, right? Those are your creditors because you have to pay back. You're taking something on credit. So you have goods that are uh, purchased on credit and goods that are sold on credit. This is exactly what we've been doing, right, in class. So now the goods that are purchased on credit, those are your trade payables because you have to repay. You have to pay back, right? But at a later stage, that's what credit means. I don't know why I'm repeating this, but due to the fact of what I've seen you've been answering is like a certain principle that you're not understanding. Where is the money going? When you're doing the trade payable, obviously money will come out of your pocket, right? And then it's going to the supplier or the company that is selling you goods, right? Money is leaving, but the goods are coming. So you need to picture that transaction. Money is leaving and the goods are coming, right? On one side, this is money, right? Your money. Money is leaving and the goods are coming, right? So let's say this is cash. This is money. So money is leaving and the goods, they are coming into the company, right? And probably the inventory was purchased that way. And that's where you understand when we're going to be doing the calculation of the working capital. But first of all, when you're looking at the current liability, the money that you will have to repay, all of it, all of it is trade payable. It is part of the current liability. So this amount that they gave you, 166,000, inclusive of that, is going out, right? So because you have to the amounts that you're paying for the goods plus the VAT all together. That's why we say inclusive. This money will go to your creditors. You will need to repay that amount. Very simple. There is no calculations here to be done to exclude the VAT. But now, when money is coming, when you have a trade receivable, meaning that people are purchasing from you, right? We have our datas, people who have bought from us, from the company, this company, MT. People have purchased from it on credit, right? So if people have purchased on credit, meaning that money will come in the company, and that money that will come in the company, right? Because goods left. Now, this is the other way around. So this is for trade payable. For trade receivable, okay? Uh, for trade receivable or receivables, however you put it, right? Depending on many trades that you are doing, right? So this time, what has gone outside the company? Remember, from the perspective of the company, always picture yourself as if it is you. You have your own business. You are the entrepreneur here. So your trade receivable is that you are selling goods. It's the other way around. On credit, what is coming or what will come is money because money will come in. So if money will come in, you have to pay SARS because you are collecting that on behalf of SARS. You read that in the textbook. Everybody who's doing trading is by default working on behalf of SARS to collect that. You read that. It is in your textbook. So I think this was again a good question because we covered this when we were practicing. So now, do we understand the principle? Is the principle clear? Because we have trade receivable and we understand that once we receive the total amount, there is money that is for our goods, but there is also the VAT that we added. That's why whenever you're going at the shop, whenever you're going to buy your groceries, check at the slip. You will see that there is VAT there. It tells you 15% VAT. So on top of the good that you are purchasing, the store is also collecting VAT. Meaning that the company, after they have sold goods, they're gonna need to give back the VAT to SARS. Do we understand each other? Is this clear? Marty, blessing.
Yes, clear, very clear.
Okay, Shreya is also here. Right. I blessing. Is this clear what I just said now? Very so whenever you see VAT inclusive, yes, that means that you need to take into account VAT, but it should not be a problem. And that's why you see here, when you have a trade receivable, you have a VAT output. Why is it called an output? It means that this is money you owe SARS. So you need to calculate the amount, you need to calculate the VAT, and you know that this amount are owed SARS. That is part of your current liabilities. So for the first point here, the goods that are purchased, the entire amount, as you can see, where am I here? The entire amount of 166,000, this entire amount here is a trade payable. It is VAT inclusive. You don't need to worry about that. The person who has to worry about that, it is your suppliers. It's the company that is selling goods to you on credit, because they're gonna need to recoup this VAT on behalf of SARS. You don't worry about that. You are paying them the full amount. But you need to worry about paying back SARS when you receive money. In that money that you're receiving, you must always ask yourself the question, I'm receiving money. Where is the cut for SARS? Where is the portion that belongs to SARS? Give to Caesar what belongs to Caesar. Do you know that saying? Always, when it's money in your pocket, always ask yourself the question, I need to pay. I need to give back what belongs to SARS. So I owe SARS something. And that's all it's about here, right? But again, to my greatest shock, right? So as you can see, for the current liability, you have the trade payable, you have the output VAT, which is also part of the current liability. We will just discuss right now how you calculate that. As you can see, it's 15%, but 15% of what? Not of the 100%. Because remember, if it is VAT inclusive, it is 100% plus 15% that belongs to VAT. When you are charging your datas, you are charging 100% of the value of the goods. That's your 100% plus that VAT that you are adding, 15%. So that's why the total should be 115%. Does that tell you something? We were doing this calculation together, because 115% divided by 100 gives you 1,15. And that's where we say, if you want to exclude VAT, you have to divide by 1,15. I repeated this so many times. If you want to exclude VAT, so if they tell you it is VAT inclusive and you want to exclude VAT, you have to divide by this. So I hope all of you have calculators there. I hope you have your calculators. Then let's do this, right? Now remember, what was the amount of the trade receivable? If we read here, settlement of an outstanding data account, we will come to that. But the goods sold on credit. So we, the company, MT, the MT is made up of Shreya, Blessing, Patrick, and Marty, right? We, the company, right? We sold things on credit, right? So what was the amount that we charge? 124,500, inclusive of VAT, meaning that a portion of this is the real 100% value of the goods, but plus 15% because it is VAT inclusive. So that's how you need to see it. So this amount that you are seeing here, 124,000, there is the three simple rules that we were studying when we were in high school or primary school about how to do the calculation. Yeah, right? So we're saying this amount here constitute 115%. All right? It constitute 115%. Now, when you want to find out what was the real 100% value, right? The real 100% value is going to be this amount multiplied by 100 divided by this. So as not to complicate, that's why I gave you this. Either you do it this way. If you're struggling with this way, like, oh, no, I don't even understand. No, but I'm saying this amount, the way you need to picture it, it's actually 100% plus 15% VAT. The same thing also if they say there is a markup. What does the markup means? It means on top of the 100%. You have 100% plus on top of that 100%, because what is 100%? 100% is the actual cost. And that's why they tell you the markup of 55% to their cost adds on a markup to the cost. So the cost itself is 100% cost, right? That's the cost is 100%. When you want to add the markup, you add the markup, the 55% on top of that cost. What is the total? The total is 155%. What does 155% represent in a fraction? I told you it's 155 divided by 100. My disappointment is that an additional little course was provided to you for fraction. Now, it seems like not some of you have neglected that, did not even bother, to do those fractions. If you are struggling with simple, this is not mathematics. This is simple calculus. And if you find yourself you are struggling with simple calculus, why didn't you take time to do the little basic math course that we put together for you? So 155 divided by 100 equal, if you take your calculator, you do 155 divided by 100, you find 1,55. Remember that? So now, this is basically what I'm showing you here. So this will be to exclude the VAT. When you're doing it like this, 100 divided by 115 is to exclude the VAT from this amount. When you say 100 divided by 155, because remember, goods sold on credit to the value of 125,500, right? Inclusive of that. MT adds on a markup of 55% to their cost. Basically, what they're telling you is that this amount contain already the 55%. It contains it. So how will you find the original cost? You need to exclude the VAT, you need to exclude the markup. You need to exclude the VAT, you need to exclude the markup. Because you are going back to that 100%. And that's why you have to do 100 divided by 115, 100 divided by 155. So to make it simple for you, say to you, every time you have to exclude VAT or exclude something, divide it. So for the VAT, you divide it by 1.5. So now let's try. You tell me if you get it. Take this amount, exclude the VAT from this amount by dividing it by 1,15. What do you find? Entrepreneurs, your calculators. Okay, let me check it. That's right. That's right. Okay. So that's the amount that you find. Now, from the amount that you found, you can round it even. You can round this amount. Remember, they told you that you must be rounding to the nearest rand, right? Did they say that in the first question? Look here, round off your answers to the nearest rand. They told you that. So what you do is, if you find this amount, 268, you must round. Remember, the comma is 86. So the nearest rand will be, instead of 0, it's going to be 1. Now, this means that we have excluded a VAT. We have excluded the VAT because remember, we added on the VAT when we were selling, but we also added a markup. We need now to exclude the markup to find the original cost. The original cost, the cost of the actual goods, how much the goods really cost to us, right? We need to divide by 1,55. So divide this amount here by 1,55. What do you find? There you go. You found this amount here. So this amount is the value of the inventory. It's not the value, sorry, it is the cost, or the value cost. It is the actual cost. So it cost our company that amount. So in our working capital, obviously we're gonna exclude that. We're gonna exclude that amount, right? So let's move on now to the sorry, my phone was not on silent. I thought that it was. All right, so let's move on now to the trade receivable. We know the actual trade, the entire trade. We know what it is, right? It's 124,500, right? We know the actual trade. What is this trade receivable? Remember, every time you picture the trade receivable, what does it mean? I want to hear it from you. What does this mean? Come on, entrepreneurs. Trade receivable. No, 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 no. I was talking in terms of things going out and things coming in. That's what I want to hear right now. I want the simplest way for you to define. Every time you see trade receivable, what does that mean to you? No, no, blessing. I just said it here. Trade receivable. Money is coming in, goods are going out. We are selling the goods. We're gonna receive the money, we give out the goods. In fact, the best way to represent it is that the goods are going right now. We're going to receive the money later. Is this clear? Reassure me, Marty, Shreya, Blessing. Is this clear? Always picture yourself that way. So, in terms of money and goods, what happened when you have a trade receivable? The goods go out, the money come in. That's why I've spent my time to show you this. The trade payable is the opposite, right? Trade payable, it's the goods that are coming in and we're going to pay the money later, right? Because we need to buy goods, we're also selling. We are buying things, we are selling things, right? So the trade receivable, the money comes in. And that's why you understand the entire trade receivable is 124,500. That's the entire. But they tell you it is inclusive of VAT, it is inclusive of the markup. So that's why you must look at what is the total working capital. Total working capital means how much will come in, how much will go out. How much will come in, how much will go out. That's your total working capital. It's money. It's the flow of money, right? So the total money of the trade is 124,500, but you need actually the actual money that you pay to buy those goods is this amount. So that's why basically you've been excluding, you exclude the VAT, you exclude the markup to get to this, because this is what I paid to buy this inventory. This is the value. This is the cost of the inventory. 69,846. Is that clear? I don't want in the exam that any one of you may be scared or afraid of, oh my goodness, VAT inclusive, VAT medun now. But what's going on? Guys, VAT is simple. You just need to know the logic of this. You see, and that's why I'm a bit disappointed, because guys, you should have practiced this. You should have practiced this. The test is showing that you are not practicing this and you are not understanding this. So this is the amount of the inventory. This is the total, basically. Basically, it's whatever we've been doing here. Um, Remember the sales and the cost of sales? Yeah, wherever there is sales, there is also the cost of sales. Because how much did it cost you to buy all the raw materials to make that sales? That's what it's all about. For you to determine how much profit or gross profit I'm getting, I need to, this tells you the trade receivable, this is the amount I'm receiving, this is the amount I need to pay to make this trade receivable. So here it is. So this trade receivable, it's part of your working capital. What else is part of your working capital? They tell you again, there is another trade receivable that you did. Okay, another trade receivable, right? They say settlement of an outstanding debtors account. So there is your debtor, one of your debtors want to settle, and you as a company, you gave him a discount. The amount paid after the debtor took advantage of the company's 4% early settlement discount was 7,500. So meaning that you as a company gave a discount to your debtors and say, if you settle me early, right, you get a discount of 4%. And they did. They took the discount, they settled, and this is the amount. So now the question is, what was the amount before this one? Before I gave the discount? What is again the 100%? That's what they're saying. Remember here, 100 divided by 100 minus 4% is what? 96, right? You take 100 here. you take 100 here minus 4%, 100% minus 4% equal 96%, right? 96% equal 96 divided by 100. I don't know, but I still need to do this because I'm so scared of you guys. Because sometimes even fractions are becoming a problem. What is this? If you type it on your calculator, 96 divided by 100, the simplest way to put it as a decimal is 0.96 on your calculator. All right? You remember that. But what they want this 100. What is the original 100? We know that this 96% represent 7,500, right? 100% represent what? Rules of three simples. You multiply, you divide by this. That's the rule of three simples. We studied at the high school level. 100 multiplied by 7,500 divided by 96. That's why I put it for you here in simplest form. 100 divided by 96 will give you an amount that is bigger than the discounted amount. When you see you receive an amount that is lesser, that should already ring, that should already sound the alarm. How can the discounted amount be greater than the original amount? No, it should be lesser. So you know you will get a bigger number here. All right? What was the cost? That's the question. Trade receivables. Ask yourself the question. The goods that are sold on credit, what is their real cost? What is their 100% value? It is this one. That's the real cost. So cost means that you spent money, but how much did you get? Obviously, you got less than what you spent because you gave a discount of 4%. So that's the working capital here. So there is a bit of a loss here. You made a bit of a loss of 313. One of you got that right. I don't know about others. Obviously, I haven't finished marking everything, but one of you got that right. So they understand that what they're asking me, what they are asking me here is to find out, is this trade, is this money going out, money coming in? Was it favorable? Was it not favorable? We can see here for this trade receivable, it was very favorable. Especially when we have a markup of 55%, obviously it's going to be very favorable. But here, it's not favorable. Trade payable. We have to pay, right? Remember, every time we have to pay, we don't need to worry about that, right? We're paying the total amount we pay, right? Because whatever we're paying can be inclusive or exclusive of VAT. But here, they don't ask you about VAT. So if they don't tell you anything about VAT, forget about it. Think about something else. They are telling you there is a 2% early settlement discount. Now, this time around, it is not us giving a discount, it is our suppliers giving us a discount as a company. Are you picturing that? Shreya, Blessing, Marty, in our company, they get, so the supplier, whatever we are buying from our suppliers, they give us a discount for the goods. To say, okay, we give you a discount of 2% if you settle earlier. If if you settle earlier, we give you a discount of 2%, right? So we take that discount and we only need to repay 10,000 rand. It is a discounted value, 10,000 rand. But what is the actual amount? The actual amount we ought to have paid is part of our current liabilities. What we know right now is the cash that we had to pay for early settlement. We paid straight right now. If we pay something right now, right, it's not a liability anymore because we are paying it right now. A liability is something that we need to pay later. That's why it must be the actual 100% value must be part of our current liabilities. How much in total was it of the current liability? That's why you should not put this amount here. You should not do that. You should just look at what you paid right now as cash that you put as part of your working capital. 10,000 Rand was paid cash, right? We paid it cash, we settled early, we took the 2% discount. How do we find the original amount? Well, 100 divided by 100 minus 2%. 100 minus 2%, 2% is 98%, right? So 100 divided by 98, 10,000 multiplied by 100 divided by 98 gives you the 10,204. So that was the original liability. That's what we owed originally. But in the working capital, we only paid 10,000. Is that clear? Is that clear?
Clear. Thank you, Patrick. Clear, clear, clear.
All right. But somebody say, well, but Patrick, this is what about here? What about this one? What about this original trade payable, right? Why didn't we do the same? Why is there not just one amount? Okay? Remember, the original one, the reason why we had to calculate and separate these two is because that is there. Remember that, because they say this is VAT inclusive. So if it's VAT inclusive, how do you exclude VAT? You know how to exclude VAT. Here it is. So if you take the 166, again, use your calculators. You have your calculator? 166,000 divided by 1,15. What do you find? Practice. Practice. This is the time. What do you find? Exactly. Exactly. You find this amount here. And that's why you see this amount here. That's what you find. That's what it's there. So this amount, obviously, if you want to find the actual VAT, the input VAT, the input, that's what we call the input VAT, not the output VAT. The input VAT is what we paid as VAT. The output VAT is what we owe SARS. And I spoke about this. And again, go back through this recording over and over again so you understand. If money is coming in, you must ask yourself the question, what is SARS cut from the money that I have? I need to give to Caesar what belongs to Caesar. Remember that. What belongs to Caesar? Because it's money that's coming in. But for a trade payable, it's not money that is coming in, it's money that is going out. What we are concerned about is just to know what is the value of the items that we bought, and what is the value of the VAT that we paid also on top of that. That's all we want to know. That's why you see we don't say plus minus. No, there's no plus minus, because all of this we paid out. It was part of our current liability. We paid it out. So remember, for trade payable, you do not need to worry about paying back SARS, because the money is not coming in. You are not receiving money. You are paying money out to get goods. That's all. So you need to understand this very important difference. Get it in your mind. So then when you add up everything, obviously you'll find the total current liability. So you add up everything here. For the current liability, you have the trade payable, the total trade payable, you have the output VAT. That's why when you're looking at the balance sheet, they will always tell you output VAT. Output VAT is part of the current liability, because it is what? It is money that you owe SARS. Okay, so everywhere there is trade payable, see this trade payable, it is your liability. So you add them up together, and this is the total amount that you are finding. Okay, I'm gonna need to erase some of these things so that it doesn't bring too much confusion there. Let me see. I don't want to make it too messy, right? But I'm doing this so that you can see the arrows, you can see where it's going, you can see the explanation. All right, so I hope this is clear. But my thing is this: if you did not practice this, even if you understand it today, tomorrow morning you're going to forget about this. Because why? You just didn't practice. That's not right. So the explanation can sound right today, but it's it's finance. It is a numeracy module. You need to practice the numbers. And if you add the total working, obviously here is the total working. And the total working, obviously, it's basically as if you are removing the trade payables. That's all. So you have your current asset, you are removing the trade payables from your current asset, right? That's all that it's about. But it's more concerned with the flow. The working capital is concerned with how much is going out, how much is coming in, how much is going out, how much is coming in, how much is going out. So we can say that there is a positive that came in. This is the total that came in. It's a positive number. Do you see this? Look at this. This also is the total of the current liability of what is going out. So if we minus these two numbers, we will find what is the net working capital. And by the way, it is part of your definition of what the net working capital is. Current asset minus current liability. Current asset minus current liability. But even if you made a mistake here and there, it should not get you to fail the question if you understand. The problem that I have is with those that don't get it at all. You don't get it. So then you need to ensure to practice quite a lot, right? So that was question one. I spent much time because this was easy marks to grab. How much was it? So it was about 10, 20 marks. So definitely you should have grabbed maybe 15 marks out of this. And the so far the one that did well grabbed around 14 marks, but I haven't marked everything again. But but that's good. When you have 14 out of 20, that's really good, right? But now you need to keep it up. This one,